Hey guys, what's going on? It's Kane here, or Wiser Dividends. Today I'm going to be going over Altria, ticker symbol MO, and is it a good buy or no? When we look over here at the stock price, over the last 1 year, they've stayed relatively flat, barely moving at all. They've had very minimal dips and very minimal large price increases. When we go to the last month, we can see that they're essentially almost flat every single day, changing at the most by 50 cents. When we look at the earnings over the last 10 years, we can see that they've grown from 65 cents in October of 2013 all the way up to $1.31 as of this August. When we go over to their annual statements, we can see that their income for the year of 2022 was $20.68 billion. They had $6.42 billion in cost of revenue with a gross profit of $14.2 billion and an operating income of $8.5 billion. Their income tax expense was $1.6 billion for a 35% tax rate, a little bit higher than in 2021 and in years previous, but significantly less than it was before 2018. They finished with a net income of $5.7 billion, a gross margin of 69%, an operating margin of 41%, and a net margin of 28%, with an earnings per share of $3.22 with 1.823 billion shares outstanding. Their balance sheet had $4 billion with cash on hand, 1.8 billion in net receivables, for a total current assets of 7.2 billion and a total asset column of almost $37 billion. They have $1.5 billion in short-term debt with almost $9 billion in current liabilities. They have $25 billion in total long-term debt with a total of $41 billion in total liabilities. The stockholder equity is minus $3.9 billion for a total debt of $27 billion and a net debt of $23 billion. If we look down here back in 2017, we can see these numbers are starkly less. The main reason for that is because of Altria's investment in Juul. If you know anything about Juul, you know that the federal government made it so they could no longer sell their products in the United States, which cut the value of Altria massively because they owned almost all of Juul. When we look at the annual cash flow, we can see that the net income for 2022 was 5.7 billion, much more than in previous years. They wrote off $226 million and had 8.3 billion in cash from operations. They invested almost $800 million and had a $1.1 billion debt repayment. They repurchased $1.8 billion worth of common stock and then paid out almost $6.6 billion worth of dividends. They had $9.5 billion from cash and financing with a net change of minus $500 million. They had an operating cash flow of $8.3 billion and a free cash flow of almost $8.1 billion. Their quarterly income statement for quarter two was $5.5 billion in revenue with a gross profit of $3.8 billion. Their operating income was $2.9 billion for an effective tax rate of 51.6%. They finished out with a net income of $2.1 billion and a net margin of 39%, leaving them with a $1.19 earning per share. They finished out with 1.782 billion shares. On the balance sheet, we can see there was $874 million with cash on hands, with 37 billion in assets and 24 billion in total long-term debt, with 40 billion in total liabilities and then a net debt of 26 billion. Their revenue by quarter over quarter started out at $1.27, and then 2005 it went up to almost $8.60. Right now we are at $3.05, up from 2009 at $1.97. When we go to the 10-year chart, we can see that they've consistently increased their revenue per share year over year and quarter by quarter. And the revenue per share has increased from $8.80 in 2013 to $11.35 in 2022. When we look at the revenue per share, we can see that it does go down 3 quarters of the year, but normally around that second quarter of the year is when they report the growth rate, which has been 14% as of this year, 12% as of last year, and then 15% in 2021, and then multiple other larger increases in the subsequent years before. The annual revenue for 2021 was minus 2% for an $11.35 revenue per share. It grew a little bit in 2021 up to $11.51, and then increased roughly about 2.5 to 3% from 2013 all the way up to 2019. When we look at the price to sales ratio over the last 10 years, we can see that it started out in 2012 at 3.6%, going up to 7.04 in December of 2017, and it's currently around 4.03 as of December 2022. When we go to their margins over the last 5 years, we can see that the gross margin is 69%, slowly increasing year over year. The operating margin has stayed roughly the same at 53%, and their net margin is almost at 39%, a lot more than in subsequent years before. When we go and look at the 10-year stock-based compensation chart, we can see in the blue that is the stock compensation, and then the orange is the free cash flow. We can see that 2013 they issued $115 million of common stock, and then they had a free cash flow of 2.4 billion. What's nice about Altria is that their stock-based compensation is extremely low most years, aside from 2019 and 2021. If you look in 2019, they issued almost $5 billion worth of common stock for only having a free cash flow of 2.8 billion. And then the same happened in 2019, with the largest difference in 2021, with almost $6 billion in common stock being issued for a revenue of half of that at $3 billion. When we look at the dividend summary, we can see that over the last 10 years, the dividends have increased from 48 cents per quarter all the way up to 98 cents with this most current increase in quarter 3 of 2023. When we look at the 10-year CAGR, we can see that we're at 7.4%. So a pretty good amount. And then it's slowed down in the last 5 years at only 4.14%. And for the last 3 years, we're at 4.45%. But luckily, we've started to increase a little bit. And over the last year, we are up almost 9%. When we look at the historic dividend yield over the last 10 years, we can see that in 2013 they were at 9%, and then they slowly went down, and now we are slowly starting to make that trend up once more. When we go to the shares outstanding by quarter, we can see that we had in 2014 almost 2 billion shares outstanding in every single quarter since then. The shares have slowly dwindled down to where we're at less than 1.8 billion shares. When we go to the all-time chart, we can see that back in 1985, they were at almost 2.9 billion shares with 2.85 common shares being issued. So we've come down significantly, and I can only see, especially in the future, this amount going down a considerable amount more. If we look per year, we can see that they roughly get rid of about 1%, with some years being in the upper ones. When we look at their stock splits, they had multiple splits, one in 1966, 67, 74, 79, 86, 89, and 97. When we look at the complete stock valuation, we can see that the metrics on Altria, they have a almost 19% return on assets with a 407% return on equity. They have a return on investment of almost 34%, a profit margin of 33%, and income of $6.8 billion with almost $21 billion in sales for a price to free cash flow of almost 8.7. The dividend data on them is $3.85 per share for a dividend yield of 9.19%. They have a payout ratio of 115.4%. And if we look at the moving averages over the last 20, 50, and 200 days, we can see they are all negative. When we look at the current price, they're sitting at $41.91. They are up almost 3% though over the last year, but over the last two, they are down 15%. When we look at the market cap, they have a market cap of almost $74.5 billion with a price to earnings of 11.01. They have an earnings per share of $3.81. The 52-week high is $48.11 with a 52-week low of $40.35. They have a beta of 0.59, so they are not a very volatile company at only 1.06 to 1.17%. They have a relative strength index of almost 29 with $6.5 billion in volume. They have an institutional ownership of 59.6%, with their shares outstanding being almost 1.8 billion and an analyst price target of $49.34. When we look at Graham's revised valuation formula, which is the stock, ticker symbol MO, and then we take the earnings per share, multiply it by 7 plus 1 times the rate of average AAA corporate bonds at 4.4 divided by the current yield, we come out to an intrinsic value of $76.50. When we take it compared to the current price right now, is almost a 55% difference. When we give a 15% margin of safety, this gives it a price of $65.02 for an acceptable buy. When we look at the discounted cash flow, we can see that the average growth rate is 17%, with an average growth rate of 10.84%. They have a perpetual growth rate of around 2.5%, with a discount rate of 9%, giving them a $51.65 discounted cash flow price per share. The current price is almost $42, with a difference of 23.23%. When we take the multiples valuation model, we can see that they have a average PE of 11.55 with a median PE of 10.44. When we look at the dividend discount model, we can see that the average growth rate is 3.93%. I'm projecting a 2.5% future growth rate with a 9% discount rate, giving it a $61.82 dividend discount price per share. At the current price, it's almost a 50% difference at 47.5%. When we add up all these together and then divide them, we come out to an intrinsic value of $58.49. When we take the current price and with a 28.34% difference, and then factor in a 15% margin of safety, that gives us an acceptable buy price of $49.71, telling us that this would be a good buy. My current thoughts on this company are I'm really liking it. I like what they've done, And although the dividend yield is significantly higher than a lot of people would like at over 9%, I still have a lot of faith in this company due to the fact that they're a dividend king. And I think that their management is really good. And being that this is a cigarette company, I just feel that the time is no better to buy this company than now due to the yield on cost you can buy it for. And I have all the faith in the management for this. So my personal thought is this is a good buy.